Bull market rally continues. Is this the return of the bull or just another bear market rally? We'll talk about that on 3 minutes on Markets and Money. Bull market rally continued yesterday. As we discussed, we broke above the 50-day moving average on Tuesday, and then yesterday, markets actually sold off kind of intraday, retested that 50-day moving average, closed higher for the day, confirming this break above the 50-day. So from a bullish standpoint, we certainly have a lot of bullish inputs here. Technically speaking, MACDs are currently on a buy signal. As we said previously, that's giving support to this kind of rallying market. And also, if you notice, the markets are in a very kind of defined uptrend channel at this moment. So again, prices are trending higher. We're getting higher lows as we kind of go through this process. We based here, markets now pushing up above resistance. Now, the next level, of course, is going to be this 2 standard deviation move above the 50-day moving average, which is going to get us to around 4170 on the S&P 500. So again, a rally between where we are now and 4200-ish is going to be the likely move of this market. Now, that's going to be very similar to what we saw back in March of this year. We saw the market base back in March. We broke above the 50-day. That rally continued to the top of the 2 standard deviation channel before then peaking and coming back down and setting new lows. If this is a bear market rally, that's certainly well within the context of what we could be talking about here over the next couple of weeks. So again, something to be thinking about as we move into September and October, which are typically seasonally weak months of the year. Is this market rally going to kind of give up the ghost, particularly if the Fed continues to be more aggressive about hiking rates, if inflation remains at higher levels and keeps the Fed on a more aggressive tightening policy? Also, of course, watching economic data coming in, that continues to weaken here. Manufacturing indexes, etc., all starting to show signs of slowness. That's going to, of course, feed into earnings as we get into later this year. Now, analysts starting to bring down earnings estimates already, but not enough to potentially justify for a recession if we're going to get into one later this year. So again, pressure from a valuation standpoint is going to be an issue. The other issue that we're going to have to contend with is just less liquidity in the markets. And as Michael Leibowitz just wrote about yesterday on our website at realinvestmentadvice.com, liquidity and valuations being the 2 cornerstones of the markets. Well, that liquidity is getting extracted. The ECB now expected to hike rates by as much as 50 basis points. The Federal Reserve looking to hike 75 basis points next week, maybe continuing that in September and November as we get through the next meetings, continuing to hike rates, tightening monetary policies some more. And of course, the dollar has been exceptionally strong, and that's also creating more tight monetary liquidity conditions in the overall economy. That could all weigh on stock prices. So again, while we could see a very good counter trend rally in the markets back to these previous levels around 4,200, that still seems to be right now at least the best case for reducing equity exposure, raising a little bit of cash, hedging risk accordingly, because again, at least a retest of these lows would likely be in order before we could actually come back and say, yes, a bottom has been put into the markets, and I don't think we're there just yet. That's what we're looking at right now in our portfolio management. I'm Lance Roberts for 3 minutes on Markets and Money. See you back here next time.